We're getting closer and closer to another record high on stocks. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Iran may pause shipments through the Strait of Hormuz in an effort to avoid escalation and keep peace talks on the table.
And a mixed bag, bank results. JP Morgan CEO Jamie Dimon sounds off on geopolitics, the Fed, and AI.
Plus, United explores a blockbuster deal with American that could shake up the industry and spark a regulatory fight.
That would be incredible.
It would be bonkers.
Truly, truly bonkers. That's the appropriate adjective for this situation. I'm looking at the bank stocks this morning. You can see a very mixed performance for them. JP Morgan, I have to say, across the board, really strong numbers, except for the fact that it guided lower for its trading revenue for the year. Citi, really strong numbers, some records when it comes to varieties of their trading figures, including equity trading. Wells Fargo, it was a miss across the board. At interest income, they reported also, for the first time ever, very granularly broke out their exposure to private credit. $36 billion is what they see. We also heard from the asset management giant Blackrock, $130 billion in client cash in the first quarter as ETF inflows surged. Catherine Doherty will break that all down for us later in the show, Matt.
That's very cool. Wells Fargo breaking out those numbers because I think shareholders demanded.
Yeah, to be clear, they've broken it out on other filings, but this is the first time ever on an earnings report where they said, here's our exposure to private credit.
Well, we're going to talk about that. Also, we're going to talk about Bloomberg scoop. United CEO Scott Kirby pitched a possible tie-up with American Airlines to senior government officials. That would create the world's largest airline. In normal circumstances, it would be a regulatory nightmare, probably a non-starter. But maybe it could happen now. You see United Airlines rising 2%, American up almost 9%. So the U.S. could get fewer and fewer major airlines. There's only 4 right now.
And if this is something that could happen, like what else in the world could happen? What other kinds of mergers of different industries, of giants that could we get? Let's get back to those bank earnings, though, with Bloomberg finance reporter Catherine Doherty. I know we got a lot. Maybe let's just start with the behemoth that was JP Morgan. What were the takeaways there?
So trading strong across the board. This is continuing what we saw from Goldman yesterday. Citi as well reporting today with strong trading results. Wells Fargo as too, but they're on a much smaller scale than those 3 other banks. And I think that the other kind of strong point across the board was investment banking, specifically advisory. So for JP Morgan, they're also reporting one of their strongest quarters for advisory on a year-over-year basis. It is up. This is consistent with what they were signaling last quarter, which was that a lot of the deals that they saw towards the end of the year held off. You're seeing that come through in the first 3 months of 2026. And the other kind of numbers that we're watching, the disclosures from both Citi and Wells today, you mentioned the private credit exposure. So they're giving a lot more detail today. We had Citi put forth their $22 billion in the first quarter, but they're noting 0 losses. So while they're giving more disclosure, they're also giving some comfort to investors and across Wall Street, saying this is our specific exposure and this is these specific losses that we have seen, giving some comfort there.
So JP Morgan does very well on trading, pulls back on the forecast a little bit. Wells misses a couple metrics, including revenue. Citi's the only one with a clean beat, right? I mean, a very impressive move from...
Except for their banking division. I think there was a slight miss there.
Yes, so their banking division was a slight miss. That's a good point, Dani. But I think across the board, this is consistent with what Jane Fraser has been signaling to the street, has worked really hard to bring the company forward from their completing the back office and regulatory reporting problems that the bank has seen. So those have been the target of penalties imposed by banking regulators in the past. We're really moving forward with that, is what you're seeing in these results. And from the commentary that you heard from Jane today, talking about their diversified business model, which is continuing to drive the revenue growth, is what she's noting. And then you hear some skepticism. She says that we remain a source of financial strength and trust for our clients during uncertain times. This is very consistent across what you've seen, the statements coming out from the CEOs of these banks. They're noting their own strength and what they're seeing as resilient consumer spending and savings across the board, but they are making note of this uncertain economic environment.
All right, Catherine, thanks very much. We're going to continue to talk to you about these bank results. Bloomberg finance reporter Catherine Doherty. On the data front, U.S. wholesale prices rose by less than expected in March, despite a surge in energy costs tied to the war in Iran. Let's discuss with Bloomberg macro strategist Michael Ball. So I guess the PPI numbers not as concerning as they could have been.
Again, everyone's wondering when the shoe's finally going to drop. When are we going to see the effects of the higher energy crisis that's occurring right now? So far, it's not necessarily moving beyond just the energy data that we're getting in these official prints, which is a positive because then again, as we know, risk sentiment is improving. We are building on this kind of positive vibes that the negotiations are still on track. And as a result, we can see kind of continual appetite to take on greater exposure as funds start to net up, the retail starts to re-engage again.
Just on that point, I mean, the S&P 500 is now back to pre-strike levels. We're up 8.5%, more than that, from the low we hit on March 30th. It's the second best run over 9 sessions in the past 4 years, only surpassed by the bounce back from Liberation Day. So is this a market where there is anywhere we are still pricing in a war premium, or is it back to business as usual?
It's starting to look like it's back to business as usual because the option backdrop is something I always like to lean into. Has become far less negative. We're seeing actually call buying now as it's become quite lucrative now, given how cheap calls were, given where put call skew was. But basically what that means is everyone had downside protection. Now everyone has sort of had to be taking that off. It's become very expensive to hold. You've lost money on all that. And as a result, now the chase is sort of occurring as people are falling behind the benchmark. To your point, it's been kind of an astronomical shift so quickly.
In terms of what we see in markets, I mean, we're almost back to record highs on stocks. We closed yesterday at a higher level than we did on February 27th. So before, the president started a war in the Middle East. Why all this optimism? Is it just that higher oil prices can't hurt our earnings?
There's a little bit of that. There's still this hope that there's the window of where this kind of higher oil price hits the real economic activity is available, meaning that this can all kind of end and we can still salvage from a global recession. And when you look at some of the surveys, we saw a Bank of America survey recently, there's still a very large belief that it's going to be a soft landing scenario from this whole scenario. But to your point, a lot of people were just caught low exposure, low net exposure. Now they're having to chase. So what started as a short squeeze last week was really concentrated more in the mega cap tech has now widened. And yesterday's breadth in the market was much better, showing that people were actually participating in cyclicals again. And small caps, as we know, are also outperforming.
All right. Michael, thanks so much for joining us. Bloomberg macro strategist Michael Ball. Now, Treasury Secretary Scott Bessent is speaking at the Institute of International Finance in Washington. Let's listen in.
Impact. They're more vulnerable to disease, to hunger, to bad education, to corruption. The World Bank and the IMF need to get back to making rational priorities. For instance, using cost-benefit analysis, as Tim also just mentioned. These organizations used to lead the world in cost-benefit analysis. As I've argued for a long time, and the reason I think we're having this conversation now, is that we need to scrap these climate targets and get the World Bank and IMF back to their core missions. In your speech here last year at the IIF, you made this exact point, and you called on the World Bank and the IMF to refocus on their core missions. In your view, how has the bank and the fund responded, and what more do they need to do?
Good. Well, Bjorn, thank you. And good to be back here a year later to talk a little about a report card for the multilateral banks, and to also, the U.S. leads the G20 this year, and I can tell you that our agenda is growth. We believe in the U.S. that the biggest risk to financial stability is a lack of growth. When I look at the choices, say, that Europe has made, that they unable to follow the Draghi report from Mario Draghi on how to increase growth. The EU was originally the European Economic Union, and it was meant to facilitate trade among the members, make it more seamless, create more prosperity, and it turns out that it's probably been a hindrance. In terms of the IMF and World Bank, I'm informed by the Grace Hopper, who was the first female admiral in the U.S., who I was a big fan of. She has some great sayings. Two of them, one is the most dangerous words in the English language are because we've always done it that way. And the second is the way to get things done is to get things done. And I think we need to step back and look at the IMF and World Bank, their core missions. The IMF, I believe, is global financial stability and stabilizing on the countries that are in bad equilibriums and getting them back to a sustainable path, an economically sustainable path. World Bank is to pull people out of poverty. And we cannot have, as Bjorn said, these kind of elite beliefs get in the way. And if we think about, I go back and I think a lot about this Nature magazine article that came out in April of 2024 that became the guiding principle for so much of the climate beliefs that GDP was going to be 60% lower by the turn of the century. And then, so it was the gospel for 18 months, and then it was refuted. So everything was based on that. So, I don't think that we can have this kind of short-termism. I think we have to stick with core principles. And I do think we are starting to see at the World Bank, they are starting to take more for energy abundance and all of the above tact. They have now gotten on board with nuclear energy. I'm not sure why it ever went away. And then the IMF, I think, needs to lead by example, probably get rid of their golf course out in Maryland, and which I said last year, and focus on global imbalances. Because I can tell you, like this slow motion buildup of global imbalances after a lack of sustainable growth is the biggest risk. The world cannot take a China with $1 trillion trade surplus.
And I think you're absolutely right. And one of those points that we believe somehow that climate is so important that we need to do everything. That the nature study that you mentioned that suggests that we could lose 60% of global GDP if we didn't fix climate change, which later turned out to be wrong. But of course, the point is, if that was really true, it should have been rich countries spending rich country money on dealing with climate change. But that's not what's happening. It's mostly rich countries deciding to spend poor people's money through the World Bank and the IMF badly. And this is not what the world's poor are telling us that they want. So I had the fortune to work together with Nobel laureate Tom Schelling, and he often asked the very simple question, how do you best help poor people? Through development policy or through climate policy? Remember, climate policy costs hundreds of trillions of dollars, and it shaves off a tiny fraction of a degree in a century's time. Development policy, like avoiding death, costs just billions or maybe even just millions of dollars and save lives right now. And that, of course, is why development policy often is much, much better if you actually want to help poor people. And of course, it also builds much more resilience. Look, a hurricane that hits poor Haiti kills hundreds of people. The same hurricane hitting rich Florida kills virtually no one, because prosperity protects people. And so we need to get this conversation back, and I think this is exactly where the IMF and the World Bank needs to get back to their core missions.
I think it has to be resiliency, supply chains. Again, I think both the IMF and the World Bank have an important role in understanding this debt loop and downward spiral that many countries are in. several countries, one in particular, have done the equivalent of a loan-to-own program with a lot of these countries, and there's a lot of undisclosed debt. There are a lot of tolling arrangements that are unfortunate, and I think only these multilateral banks can effectuate that. But again, I do want to congratulate them. The IMF was willing to say this time is different with Argentina, and Argentina's been a fantastic success. They're accumulating reserves every day as we speak. The tens of millions of people there that are being brought out of poverty. The government of Javier Milei, I'm very interested to see, it was the poorest elements of Argentine society who voted for him this time around, and the young people. So there's optimism there. And then the IMF is working on bringing Venezuela back into making it look more like a normal economy, and I think will play a very, very important role there. And the World Bank leadership in terms of energy and unlocking resources and stability for the very poorest countries, I think is back on a good trajectory.
Yeah. If you don't mind, I'll pick you up on that energy point, because last October, you withdrew the United States from the Green Climate Fund because, in your words, their goals run contrary to the fact that affordable, reliable energy is fundamental to economic growth and poverty reduction. And I think that sort of shows the general point of, we often forget how energy really powers modern life. It warms us in the winter, it cools us in the summer, it transports us. I mean, I look around this room and I think pretty much everyone is from somewhere else, and this is what energy does. Energy allows us to live better than kings of the past. Energy really is prosperity. Yet, the climate fixation that we've been talking about means that both the World Bank and the IMF has pushed for a rapid shift away from fossil fuels and towards renewables, and for total ban on fossil fuel investment. And I think they need a reality check. There's no transition taking place. Globally, we use more renewables, yes, but we also use much more fossil fuels. The world still gets more than 80% of its total energy from fossil fuels, and the decline is so slow that on current trends, we will only get to 0% in 4 to 10 centuries. Germany has spent famously 700 billion euros on its energy shift since 2002. Electricity prices more than doubled, and yet Germany's energy is still 79% fossil fuels. China produces most of the world's solar panels, wind turbines, and electric cars, but much of this, of course, is produced with coal. China's energy is still 87% fossil fuels.
I would say a Chinese EV is a coal-powered vehicle.
A lot of it is in China, and of course, especially some places which are driven enormously on coal, for instance, India. They emit more. But the real point, I think, is that poor countries want to get rich like China did. They want to use more energy, and much of this will be fossil fuels. They don't want to copy Germany, and they don't have 700 billion euros to blow on climate policies. So forcing poor nations into renewables that even rich Germany or China aren't achieving is just simply hypocritical. In your IIF speech last year, you called on the World Bank to focus its efforts on expanding developing country access to reliable and affordable energy, and you criticized its climate targets. You noted that the IMF devotes disproportionate time and resources on climate, even though it's not part of the fund's mission. So what have you seen from the bank and the fund in these areas since your speech, and what more do you expect from them?
Again, as I said earlier, I think the World Bank has made a good pivot. They are now pushing, or they are a proponent of nuclear energy. I'm not sure how that wasn't considered a renewable for so many years. I mean, if you look now, France is powering the European energy grid, and their reactors are running the full blast.
And they're also one of the cleanest.
And it's one of the cleanest. But when you think, we were the Europeans got into this terrible recursive loop because they decided to turn off their nuclear energy. The Germans became more dependent on Russian crude, and then the Russians were selling them the crude to finance the war against them. So, but I do think that the World Bank is moving to an all-the-above energy process and program, and again is getting back to the core mission of lifting people out of poverty. And I would just say too, I always find it's very good to follow not only what people say but what they do. And Bill Gates, who for a long time had pushed this climate agenda, again has also changed tack. And if you read his recent speeches, he believes we're going to innovate our way out of this. And if you look, I think the Gates Foundation has something like $13 billion of investments in energy innovation. And look, no one's expecting Deus Ex Machina one day and everything will be fixed. But in the U.S., we were going to run out of
everything.
Well, we're going to run out of everything, but we were going to run out of the crude derivatives, and then fracking was invented, and now the U.S. has the larger reserves than Saudi and Venezuela. On the other side, the IMF, I think, getting back to this message of stability, of monitoring global imbalances, of stepping in early, and I didn't always agree with Ben Bernanke's monetary policy, but what I always admired with Federal Reserve Chairman Bernanke was he had a framework. And you could almost see, if you ask him a question, he ran it through his framework, and everything was always consistent with Chair Bernanke. And I think with the IMF and the World Bank, the framework needs to always be consistent.
Yeah. I think, and on the Bill Gates point, I think really two things stand out. First of all, the innovation point that you just made. I mean, this is what has always solved the problem. Tim mentioned the green revolution that we had in the 1970s when we worried about running out of food. Remember, we didn't fix the problem of the world not having enough food by telling everyone, I'm sorry, do you mind not eating as much? And then we'll send it down to whoever it is that we worry about. The point was that we innovated a way to generate much more food. And of course, we'll do the same thing with climate. We are going to solve big problems through innovation. That's how we've always done it. But I think another point that Bill Gates made, which I think is incredibly powerful and useful when you talk about climate change, is he said, we've for so long been talking about climate as if the point is to cut carbon emissions or to reach a certain temperature limit. No, the point is to make the world better for humans. And there, the question is, do we make the world better for humans by cutting carbon emissions by whatever tons? Or do we make it better by, for instance, making sure small children don't die? Or that children get better educated in school? There's so many other ways that we can also do this. And this, of course, reflects back on the IMF and especially the World Bank on what can be done. And there are just so many incredible things that we can do first.
Yeah, again, I think keeping the main thing, and not getting distracted because it feels good, it's convenient, it's kind of part of the Davos consensus, which much of the Davos consensus seems to have been shattered.
Yes. So I want to just take us to our third and last point and talk about trade-offs. Because all international financial institutions need to get back to the core point of trade-offs. Look, the money that the World Bank spends on a solar panel can't be invested in healthcare or education. And the world's poor tell us very clearly not to focus on climate first. When Africans are asked in the Afrobarometer on what worries them the most, climate change came almost at the bottom. A vast survey of more than 50,000 Africans across 39 countries found that climate change ranked 31 of 34. The top concerns are not surprising. There's unemployment, the economy, health, education, poverty, roads, electricity, hunger, and corruption. Then it goes on for a long time until you get to 31, which is climate change. When your child might die tonight from a preventable disease, no family cares about shaving a fraction of a degree off global temperatures in a century from now. Elected leaders of poor countries tell us the same thing. In a large survey of low and low middle income countries, they show climate ranks 12 of 16 issues. Even the World Bank's own client surveys show climate ranks low. So international financial institutions should get back to focus on their strengths. As you've said, the World Bank should focus on poverty reduction and the IMF on macroeconomic stability. But the world's poor are very clearly saying, don't focus on climate first. So from your perspective as Treasury Secretary, how do you view the international financial institutions and their effectiveness in general, and the bank and the fund specifically?
I would also highlight that it's not a unique survey item among the world's poorest. Germany instituted very, very strict remodeling and rebuild requirements for German households. So you had to spend, I can't remember, it was 30, 40, 50,000 euros to upgrade to a more green house, and they're all getting voted out. Yeah. So privation is not a good motivator. But again, I do think that we are determined, as I said last year, with the multilateral institutions, the banks. The U.S. wants to be in it to win it. We want to be good partners. America first does not mean America alone. And we want to go back to basics. And these banks were invented around Bretton Woods, which was post World War II. Europe was, and Asia was a unique time in America, and it led to incredible prosperity across the world. So why can't we do that again? And why can't we focus on growth? Like, what are the tools? What is hindering growth of these economies? Is it the unsustainable debt, which is the IMF? Is it the poor infrastructure, health and hygiene, which is the World Bank? Because I think for a time we kind of skipped the foundational elements and tried to jump to something else, kind of luxury beliefs, in terms of if a government was not able to fund itself, or if people are not able to feed themselves. And I think we've just got to get back to that. I think Ajay and Kristalina have gotten the message and are moving forward in a very, very constructive way, and I want to congratulate them.
Yeah, no, that's great. And again, when you have to decide what to do, obviously, I'm an advocate for cost-benefit analysis, so I'm going to be sitting and saying they should be looking at it. But really, if you think about it, the World Bank and IMF used to be world leaders in cost-benefit analysis. And it makes sense. If you only have limited money, if you have to think about trade-offs all the time, you have to ask yourself, where can we spend scarce resources and do the most good in the world? And this is exactly what cost-benefit analysis does for you. It allows you to pick out the really, really good policies and make it just much more likely that we can actually achieve all these goals that we're talking about.
Well, yes, and I think projecting anything that, if you look, economists have trouble projecting 3, 6, 12 months, whether it's my economist at Treasury, whether it's the IMF or World Bank economists, and try to project something so far into the future. If you think about a y-axis and an x-axis, what we're really thinking about is the z-axis in terms of the trajectory. And why does the trajectory matter? Yes, the climate does change. As we all know, that the natural habitat for the Earth is actually water. Ice was probably it's a very long cycle, but ice was an unusual cycle. And we are going through cycles, and I believe that it is very difficult to deconstruct the reasons around why anything changes. But I think we've got to step back. What do we know? We know it's changing, and how do you increase resiliency?
Yeah, exactly. And resilience really comes from more prosperity. And at the end of the day, of course, yes, climate change is a real problem. But if you're poor, if you have all these other problems that you struggle with, and you're vulnerable to disease and corruption and bad education and so on, these are the things that we can really help people with first. And so this is where both the world's poor is telling us we should focus, and this is where we can do the most good. And the cost-benefit analysis very clearly says this is where we should be spending our money.
Look, I couldn't agree more. U.S. foreign policy got off course at a point in Afghanistan that it became a social mission, and the mission was, okay, we have to do this in the schools, and we have to have these goals. And now, like, Afghanistan's fallen back into ruin, and what we should have done was try to make a sustainable government rather than try to, from the top down, overlay our values on a completely different system. I think we could have gotten a very different outcome.
So I noticed that we've run out of time, but I wanted to stop you when you said, I couldn't agree more.
Right. So
thank you.
Well, thank you. And again, my message is I think that both of the institutions.
All right, that was a half hour of your life that you're never going to get back. Treasury Secretary Scott Bessent speaking at the Institute of International Finance in Washington, and I don't know what to tell you about that. Let's focus back on markets, please, because we want to see what's going on with the most important equity benchmark in the world. It continues to rise, now more than 6,900. Stocks are higher now than they were on February 27th when we started a war in the Middle East. And since then, we've seen oil almost double in price. It's coming back a little bit today, but still more than $90 a barrel on Brent and NYMEX. And yet, we continue to see risk assets soar. The NASDAQ back at over 25,500, Dani.
It is incredible for us to watch stocks price out any sort of risk premium around war. In the meantime, we are looking at some individual stocks. JP Morgan, all the banks basically reporting today, not all of them, but the majority of them. JP Morgan, they had a really strong set of results. The issue for them was, though, that they lowered their net interest income guidance, but trading was huge, as it was at Citi too, and it had its highest quarterly revenue in a decade. Shares up 3.25%. Wells Fargo, it missed on basically everything, so shares down 4%. And then there was Blackrock, notably not a bank, an asset manager. It had $130 billion in client cash in the first quarter. ETF inflows surged. As we know, retail has been trading heavily in the first quarter on the market volatility.
All right, so we are focused on the banks right now, less than Bjorn Lomborg, I'm sure. But we're seeing real movement in these shares, and also what would be one of the biggest mergers that we've seen, and what would make the biggest airline in the entire United States and the entire world, in fact. If United and American got together, which is the Bloomberg scoop, that the CEO of United, Scott Kirby, has pitched this to government officials, normally the kind of thing that wouldn't be allowed on a competition basis, on an antitrust basis, but it looks like they might try and get this done under the Trump administration. As a result, United shares are up about 0.5% in the cash trade, American up more than 5%. So some real news out today. Joining us as earnings season ramps up is State Street Global Chief Investment Officer Lori Heinel. Lori, I'll get to the banks first because we've seen, again, kind of a mixed picture, as we did yesterday with Goldman Sachs, from JP Morgan, from Wells Fargo, from Citi. What's your take on how the biggest banks in the world are operating here?
Well, look, I think this is part of a broader view around where do we see the economic recovery going from here. There was a lot of concern that we were going to have pressure here in the U.S., particularly because of inflation. Certainly, we're worried about that as this conflict continues. But I think on balance, banks have lots of different ways that they can capitalize on this environment, including a lot of the market-making activity, which has driven some of the results.
Lori, I was listening into the media call with Jamie Dimon, and he was saying to reporters, he got asked the question, at what level do you see stress for this consumer, especially when it comes to gasoline prices? He basically said that there's no level. There's no level of gasoline that would worry him as long as jobs remain plentiful and the labor market remains strong. Would you agree with that, too, that things like consumer-related companies or really this American economy can be held up regardless of what gasoline prices are as long as this labor market doesn't crack?
Well, there certainly are stresses, and particularly if you disaggregate the American consumer into those that are in a better position and those that aren't. So I would agree completely with the assessment that jobs matter, and we've been watching labor markets quite closely for many, many months now, both as signals of the U.S. economy, but also as signals of what the Fed might do. But increasingly, you have a lot of concentration of wealth. You've had markets that have rebounded radically, as we've just talked about, and then you also have a situation where a lot of these consumers already own their homes. They're seeing price appreciation in the aggregate over the last several years. So they're feeling pretty flush. I wouldn't, however, say that none of the consumers are impacted by higher energy prices. Certainly at the lower end of the spectrum, that is a concern.
What do you make of the Fed here as we see, the price of gasoline, the price of oil rise? It's not too dramatic at the pump. I'll remind our viewers that it was $5 and change across the national average in 2022, and it's only about $4.11 today. But it still is something that the Fed is going to have to contend with as the labor market looks fairly strong. I mean, still 4.3% is a fantastic unemployment number, and we added almost 200,000 jobs last month.
Yeah, I think there are a couple of things there just to pick up on. I mean, certainly the amount of paycheck that goes towards energy is just nothing like what it once was. So in addition to the fact that we're not at that $5 threshold, coupled with efficiency gains and gasoline consumption and things of that nature, all in all, it's not as big of an impact. But I think that there is some concern that inflationary pressures may not be as short-lived as we think. And if you look at just some of the underlying dynamics of what was driving the latest CPI number, there were some disinflationary things around things like used vehicles that probably are going to roll off. So I think we're in this window that for the next few months, the Fed's going to be on hold because the inflationary pressures will feel a little bit more immediate. But we still hold true to our call that by the end of the year, the Fed is cutting again.
I guess, Lori, and that makes sense. And you do see two-year yields remain elevated because of that concern. But that gets to this odd cross-asset picture where, as we've been talking, stocks are back at the levels they were before this conflict. You look at what oil has done before the conflict. It was hovering in the mid-60s. Now it's in the high 90s. And two-year yields, they were about 3.4%, are now near 3.8%. Does it make sense, even if you expect some things to dissipate, that you have yields and oil still under pressure while stocks show none of it?
I think there are a couple of things that are happening here. First of all, and you've talked about this at the top of the program, is that earnings are actually looking pretty good. So if you actually look at the re-rating that we had when markets pulled back earlier this year at the start of the conflict, coupled with actually improvement in earnings outlooks, you've actually seen stocks look relatively attractive. And then when you layer in some of the other themes around artificial intelligence and other ways that productivity gains can happen, that paints a relatively good picture. But as you also note, this conflict's far from over. And so there is still risk that we have another shoe to drop, if you will, and that the energy constraints become a real problem globally, not just here in the U.S.
We talk so much about the broadening out, Lori, but I'm looking at the index here since February 27th and seeing that even though we're up, we only have 175 stocks that have gained in that time, and the rest are down. Obviously, energy has been a big beneficiary of this war, and the AI trade is something that benefits the economy greatly, but not necessarily all of the people in it. What do you think about the idea that we're still seeing a broadening out trend in terms of earnings growth?
So we are fans of that broadening out trend, and we do think if you look at just the gyrations in market, it has been a little bit hard to parse that out. But if you look at some of the underlying factors, things like quality have done better. Value year to date, even though it's had a little bit of a lag in the last week or so when we had the sharp rally again, value stocks have done a little better. Now, that doesn't mean that the tide lifts all the boats, but I think that there is this kind of growing broader input, whether it's an economic recovery that we thought was going to have more legs, but now is threatened by the Iran conflict. But that kind of broader sentiment, we think, is something that investors should still focus on for the longer term.
Lori, we're going to have to end it there. Thank you so much for joining us, State Street Global Investment Officer Lori Heinel. Let's get a check on your equity market about 10 minutes into your trading day. And we are looking at gains 0.4%. We are less than 1.5% away from all-time highs, a remarkable turnaround for this market, as we've been discussing, that is now back above the levels of where we were pre-war. The best 9-day streak, it has been up for 8 of those past 9 days, but the best 9-day run since Liberation Day. Microsoft, Amazon, Nvidia all having good days. Amazon with a new deal to buy a satellite operator. Oracle is in the top pick too. They are now going to be buying energy from Bloom to power its AI data center. So that gets a big boost of more than 7.5%. Blackrock's also up, as is Citi, both reporting strong earnings. On the downside, as oil prices fall, so too do the oil majors, Exxon and Chevron in their Wells Fargo. Disappointment for their earnings. Shares down 5.33%. Walmart is also down. Intel is down after a big run for Intel, where they added a huge amount to their market cap, about $100 billion. Let's look at some of the sectors. Consumer discretionary having a very nice day too, maybe as oil prices come down. Infotech, a good day for them. I point out some of the big caps, but I should also note that software, IGV, the ETF, is up nearly 3% today. To the downside, it is energy. Staples are down. I point out Walmart down. Energy down 2.7%. Again, Matt, for an overall index, which is looking for another day of gains.
Yeah, I mean, 60 points away from an all-time closing high. 69.68 is what I see there back in January. So coming up, Jamie Dimon says the U.S. economy remains resilient, but there's an increasingly complex set of risks. We'll discuss today's bank results with Baird analyst David George. This is Bloomberg Open Interest.
"15 minutes into your trading day, let's see what the sell side has to say with your top calls this morning. First up, UBS. They upgrade Tesla. They say the stock looks more fairly priced after a stretch of worries about weaker EV demand, higher costs, slow progress on projects like robo-taxis and Optimism. The firm, though, still expects that those bets will improve over time, and they see Tesla as a long-term AI leader. A nice little share pop for them today, up 1.7%. Next up, Morgan Stanley says that U.S. steel stocks are looking stronger thanks to higher prices and tariffs. The firm is raising its price target on Nucor, Steel Dynamics, and Reliance. Shares up as much as 1% this morning. Finally, Wall Street is weighing in on Blackrock's strong quarter that sees their shares up nearly 4%. TD Cowen points to lower taxes and solid inflows. KBW highlights higher fees and lower costs. Evercore says that better management fees and leaner expenses show that the business is performing well. Matt.
All right, JP Morgan trading revenue beat, and traders posted their highest ever quarterly haul. The bank, though, cut its net interest income guidance back down to where it had been before it last raised its net income guidance. Let's take a deeper dive into the bank earnings. Joining us now is Baird senior research analyst David George. He has a neutral rating on JP Morgan with a price target of $290. And David, let me just start with the net interest income. What is it? Competition? Is that the holdback here?
Yeah, good morning, Matt. A couple things. Loan growth is maybe a little bit slower. Deposit costs maybe a little bit higher. I think markets revenue and the tightening of spreads is also having an impact. I would caution market participants or viewers of the show this morning to not get too worked up about $1 billion NII swing. I mean, the bottom line is this is over a $2 trillion balance sheet. They could print any net interest income number they want. I think they're just trying to be conservative and thoughtful as it relates to kind of capital allocation going forward. But overall, Matt, the quarter was pretty good.
And I mean, huge trading numbers across the board, David, for all of the banks. In the media call, we heard from the CFO of JP Morgan saying, I wouldn't extrapolate these out. We don't know what the environment is going to be like. How are you viewing the trading desk and these trading revenues? Obviously, there was huge volatility in the first quarter. Given the macro stresses we're still expecting, how does your outlook appear?
Well, we feel pretty good, Dani, about the capital markets outlook. There's a lot of M&A that's been announced in very large scale and very diverse from a sector perspective. And with the markets coming back, equity capital markets should also be relatively robust. You know, the trading numbers, to your point, probably aren't sustainable, but nonetheless, they were very good in the first quarter. It seems like many, many moons ago, but we had significant volatility in gold, silver, oil, rates, equity markets, vol, and the money center banks, JP Morgan specifically, really benefited from that this quarter.
In terms of the war and the warnings on geopolitics, I mean, does that really provide any headwinds to JP Morgan? Is it only the weakening of the consumer for slightly higher prices at the pump?
Yeah, I think you just nailed it. From my perspective, at least, I think the major kind of lingering issue and I'm clearly not a geopolitical expert, but to me, the biggest concern that I would have in terms of the macro from a credit perspective is how long do oil prices stay here, and the related impact on the consumer, but also supply chains and just kind of how, as you both know, higher oil prices kind of manifest themselves in a number of different inputs. And to the extent we stay elevated, to what degree does that have an impact on inflation broadly and corporate profit margins as well?
David, just a minute here, but some of the other headline risks that we've been watching for the banking sector, and the reason that shares had been weighed down earlier was private credit exposure. We had some details from banks, Citi out, saying that they have $22 billion worth of exposure to private credit. Wells Fargo goes even into more granular detail. $36 billion. They say only 17% is software. Is there any reason to be concerned around private credit exposure?
We're always concerned about credit, Dani, but from my perspective, the private credit, and I'm not trying to be dismissive, but the private credit fears that market participants have, I think are, we say, overblown, particularly given the size of these exposures and really the nature of these exposures. A lot of these are among the lowest risk loans on these balance sheets. These could be to large insurance companies. These could be capital call lines to private equity companies, which are extremely, if not zero risk. So it's not something that we spend a lot of time worrying about. Again, oil and the related impact on the consumer and corporate profit margins is really where we're a little more focused at the moment.
David, thank you so much for joining us. That's Baird Senior Research Analyst David George off the back of earnings from the big banks. Later today, catch the CFO of Wells Fargo. He'll be on the close at 3 p.m. New York time. Coming up, more corporate news. United CEO Scott Kirby pitching a possible combination with American, something we would not have even dreamt of in past administrations. We're going to get the details next, right here on Bloomberg Open Interest. Bloomberg has learned that United CEO Scott Kirby pitched a possible merger with American Airlines to senior government officials. That would be a regulatory long shot and would by far create the world's largest airline. Let's get more with Bloomberg Aviation editor Benedict Campbell. Benny, I don't even know where to start with this. I mean, this would be huge, monumental. Would regulators even allow this? And what does it say that Scott Kirby is even asking?
Well, I think Scott Kirby is trying to sort of push his luck here, and he pitched this, as you said, to circles in Washington, and not to anyone. He pitched it directly to President Donald Trump. That's what our reporting shows. There was a meeting in late February where he brought up this idea. Interestingly, a couple of days before the war in Iran started, which really has put the aviation industry into a sense of crisis, given what it's done to fuel prices. So, if anything, that has only sort of intensified the need for something, at least in the minds of a lot of executives. Since then, we've had Kirby come out and say, this is an opportunity for us, the current state of the industry. We've had Ed Bastian at Delta say we might see more consolidation. You have to remember that consolidation in the industry, and the industry as we know it now in the US, was built around consolidation. That always happens and it accelerates during a time of crisis. And anyone you speak to in the industry right now will tell you that this is the moment. But to your point, this is obviously a massive, audacious endeavor. And whether this is just Kirby sort of dreaming big and seeing how far he can push it, or whether it's something that's real, that's something we need to find out.
Benny, do me a favor. Compare and contrast the U.S. Airline market with what we have in Europe, because I spent, 10 glorious years living over there and taking like 30 euro flights to Ibiza. Whereas here, even on Spirit to Austin, I'm paying like $400 or $500. Why is that?
Well, I mean, in the US, you have the big four. You have Delta, you have United, American, and Southwest, and then you have sort of second division and third division type companies. And then you have some that are really struggling. Spirit, for instance, and the ultra low cost market in the US. In particular, is in dire straits. There's no doubt about that. That is different over here in Europe. You also have sort of three big groups. You have Lufthansa, Air France, and the IAG group that includes British Airways. But then you have very solid companies like Ryanair, who have really sort of mopped up a lot of the regional market in Europe. So to your point, those cheap flights that you were taking to the Mediterranean, you probably boarded a plane on Ryanair or on EasyJet. Yes. That is a market that is sort of solidified in the way that you don't have in the US. And that's where some of the opportunity lies. What's different in this case is that this is two of the biggest that would combine, and that's where a lot of the headaches come from.
Benny, thank you so much. Pleasure having you on today. Bloomberg's Benedict Campbell has been covering airlines for us globally for many years. I never went, by the way, to Ibiza.
It just made it sound like you did.
I sometimes flew to Barcelona and to Jerez, but never to Ibiza.
Let's please move on.
Coming up in the next hour, an exclusive conversation with ECB President Christine Lagarde. She sits down with Bloomberg's Francine Lacroix, of course, in Washington, D.C. Plus, the CEO of Rolls-Royce joins us later, Chris Brownridg, to show off his new $5 million car, and the CFO of Johnson & Johnson. We are 30 minutes into the trading day and 60 points away from an all-time closing high on the S&P 500. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. That's despite oil prices, which are still just under $100 a barrel, still yields higher too, and yet we're near all-time highs.
Coming up, Iran may pause shipments through the Strait of Hormuz itself in an effort to avoid, getting a boat blown up, and also escalation in President Trump's war in Iran.
And an exclusive interview with ECB President Christine Lagarde as finance chiefs confront a new shock to the global economy.
A mixed bag of bank results. JP Morgan CEO Jamie Dimon sounds off on geopolitics, the Fed, and artificial intelligence. What did he say about Mythos?
So they didn't say a lot. They just said that they know that there are vulnerabilities and that they'll have more to say later.
I've been yelling at ChatGPT to be at least as good as Mythos.
And what's it said back?
It says that's really not fair, That's
poor ChatGPT.
That's an experimental
are you bullying
large
your
language
AI?
model. Well, Mythos gets out of its sandbox and goes online by itself to brag.
While the coder's eating a sandwich and probably freaking out.
And ChatGPT doesn't even look stuff up. Like, its knowledge base ends in 2021. I need it to be better.
It's true. By the way, the U.S. Treasury, our reporting suggests that they want their hands on Mythos, too, to try to see any vulnerabilities they have.
I'm sure they'll be able to get it.
They probably would, you'd imagine.
As global finance chiefs weigh the fallout from the Iran war, Bloomberg's Francine Lacroix sits down exclusively with the president of the ECB, Christine Lagarde. Let's listen in.
Derivatives of those products will be, how long it will last, and how fast the situation will be recovered. And we keep looking at current data as they come in. And thanks to Bloomberg, for instance, this comes in on a very regular basis. And we try to figure out where we are relative to the baseline and where we are relative to the various scenarios that we have laid out.
Yeah, and I think you laid it out as three scenarios: baseline,
yeah,
adverse, and severe.
Yeah, I would call the baseline, and the other two the scenarios.
The scenarios. So where are we now?
We are in between the baseline and the adverse. So we have baseline, adverse, severe. So currently, but when I say currently, you have to look at the price of the barrel, the price of the various categories of fuel, the price of futures, and all of that applied to gas as well, to determine where we are exactly relative to these two. But we are somewhere, I think, in between the baseline and the adverse scenario.
So how quickly can that change from baseline to scenarios?
It changes every day. So the difficulty of us central bankers is that we need to take a medium-term view. This is how we define our target. This price stability that defines our mandate is done by reference to the medium-term results. And at the same time, facts, data, number of ships blocked here, volume of oil extracted varies almost on a daily basis. So we need to do this somehow schizophrenic exercise of keeping our eyes on the medium term and making sure that we deliver on our mandate, but at the same time checking the data almost daily.
So what does it mean for monetary policy? Does the baseline already warrant a hike?
What it means for monetary policy is that we have to be, it means two things. We have to be completely agile and ready to move in the direction that is required. And second, we have to be data dependent, as we have repeatedly said. But it does not predicate, as we speak today, Francine, that we will go in one direction or the other. And it certainly doesn't, determine a rate path that I can confirm today. And any of the colleagues who are confident that it's going to be one way or the other, or don't know, honestly.
Does the ECB have a tight...
But don't forget one thing. The baseline and all our scenarios are designed and formulated with the incorporation of what the market assumes. And no other monetary policy or fiscal policy decision affecting baseline or either of the two scenarios.
Do you think there's a tightening bias?
At the ECB? No, I think there is. We have a compass which indicates price stability, predicated on financial stability. Those are the two. I wouldn't call them bias. No.
How different is it from the shock in 2022, and how different will your response be?
Well, it's different from 2022 in many ways. If you look back, inflation was completely different. Interest rates were completely different. The shock was a combination of supply and demand. It was a vastly different situation. And I think Europe was affected in a much more significant way than it is at the moment. Because we had this sudden stop that came out of the war in the unjustifiable war of Russia against Ukraine, which brought to a halt the delivery of gas. That was very sudden.
I mean, at the time, central banks were blamed for acting too slow. Is there a danger? I mean, how does that impact, again, your thinking this time?
Look, I think we've said very clearly that we would need data to act, but that we would not hesitate to act. I think it really captures well the position that we have. We need the data in order to analyze whether it's see-through, it's going to be short-lived, we will get back to back to the past, if you will, although I don't think that's actually possible. And we need all that. So it's either the see-through, which doesn't require that we take any particular decision, or it's going to be long-lasting, it will peak higher, and it will require action on our part, or it will be somewhere in between, which will then require judgment on the part of the Governing Council to decide whether or not the indirect effect and the risk of secondary effect might de-anchor expectations, which then, would require action as well.
So I was at a dinner yesterday with the Treasury Secretary who was saying that actually he thinks this will be short-lived.
But he's a political leader, as well as being a terribly competent person, but he's a political leader. I'm not a political leader anymore. And our job as central banker is to stay in our line, to observe our framework. We have one, thank you very much, and to identify whether or not we are in a situation of short-lived, look through, or long-lasting act, and possibly decisively, or in between, which requires a very subtle identification of how much, when, in order to make sure that inflation expectations are anchored and we do not get the secondary effect. So that's the job. It's the difficulty of what we have to do at the moment, while at the same time very seriously looking at the medium term and being attentive to the short term.
And so your gut feeling for what we're living through now, you'll act quicker than in 2022?
I don't have a gut feeling. When I... I hear the music of this is short-lived, we will go through that, you can see through. First of all, we decide what we have to do. Point number one. Point number two, to explain to the fisherman who cannot go at sea because he cannot pay for his petrol. Or when I think of, the household that doesn't know whether they'll be able to pay for the refilling of their fuel tank. Or whether I think of the guys who have to drive to work and who see the price of oil at the pump going up and up and up. I take the see-through story into account, but this is not something that you can actually explain, which requires, from our perspective, in order to align in the most effective way monetary and fiscal policies, it requires that we have a dialogue with the fiscal policy leaders and ask them to be targeted and temporary, transparent and tailored and all those TTTT when they design support packages or help for the people who are the fisherman, the housekeeper, the household, or the guy who is driving his car.
Given where we are now, what does worst case scenario for growth and inflation look like?
The worst case scenario is war in any event. As former head of the IMF, I have seen successful program being completely wiped out by war. So war is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you, not going through the strait.
So what's the pain threshold for the euro area economy that the ECB would have to act on? Is it inflation at 3-4%, or is it?
Look, we have forecasts for inflation that vary between 2.6, which is the baseline that we have, and a little north of 4%. Based on what I told you earlier, which is see-through, strong decisive reaction, or somewhere in between, depending on the factors that we see, we will adjust because we will be agile. But one thing for sure is that we will keep our 2%.
Madame Lagarde, how worried are you about the discrepancy between spot and future oil prices, and so potentially tighter markets that we're pricing in?
I think it's the whole dilemma that we have about short-term and medium-term. And the more anxious and worried economic actors are about the resolution of this crisis, the more pressure there will be on the spot market.
How much do you blame the U.S. administration for what's happening to the European economy?
It's not my job to do, blame, to point finger or to associate this or that with blame. I'm more in the hope section myself, and I very much hope that people can sit at the table, can come to their sense, and understand that it will be in the best interest of the global economy, of the people, that a war settlement is reached and that not just a ceasefire, and that we can navigate through the straits of the world.
How long?
Which has a ramification with international law, but let's not go there. I'm a reformed lawyer, as you know.
We can go there if you want. I mean, is it something, when you look at the economic fallout, actually, in general, even if there's a truce or if there's lasting peace, how long does that play out for?
I think there are two dimensions to that. One is for shipping to resume under regular, normal conditions. It will take, I don't know whether it's 2 or 3 months. I listen to the experts and I try to understand how long it takes to fill in the ships again, to move the tankers around and to deliver. I think most of them are saying that it's a 2 or 3 months job for the shipping and the distribution. Production, refinery, that seems to be another matter. And when you look at the Ras Al Khaimah refinery facility in Qatar, they say that it's not months, it's years that we're talking about. Some of the facilities in Saudi, whether it's pipeline, probably shorter, but some of the other facilities will require long-term fixing and adjusting and repairing and setting it up again.
I mean, given all of this, is there too much financial exuberance in markets?
You know what is a little strange is that there is a tendency by some to assume that it's business as usual. And I think there is a bit of a dichotomy between between those who regard business as usual and those, on the other hand, who are saying, watch out, it's a very significant shock. And we are not about to see the end of that process because there will be ramifications. There will be impact on the price of processed and unprocessed food. There will be an impact on the supply chain if it lasts longer. And we're not going to see exactly the same disruption as during COVID, but something that will be in between normal and COVID disruption.
But do you worry about financial stability? I mean, there's also private markets.
I always do. I always worry about financial stability and price stability because they are intrinsically interdependent. So, we in the supervision function of the ECB and all the supervisors around the world have to be very attentive to financial risks, whether sort of declared and disclosed risks, which hopefully have mitigating factors associated with it. At least that's what the regulation is doing, and the rampant risks, the various black swans that are there.
What worries you the most in all of this?
It's what worries me both in good and bad, and I hope we'll never have the ugly, is the impact of artificial intelligence on our economies and the outcome and the governance of artificial intelligence. And what I mean by that is, what impact will it have on not just on productivity, where our star will go, which obviously matters to us central bankers, but what impact will it have on our societies? How many people will be unemployed? How many people will require retraining, reskilling? Who will pay for that? The whole fiscal equilibrium that will result from the massive transformation that is expected in many corners. That keeps me not awake at night because I try to get some sleep, but it's a big issue. It's a really big issue.
Are governments thinking about that, given they're also dealing with this massive energy crisis?
I've been in government a few years of my life. What is really difficult is to focus on the day-to-day, to mind the next election, to respect your program or the expectations that your voters have, and yet at the same time to anticipate what will be the effect of major breakthrough, innovations, significant developments. And I think that in that category, AI is something that we need to have at the front of our mind because it is moving so fast and because the impact of it can be so disruptive for good or for bad. I think the development we've seen with Anthropic and Mythos is a good example of a responsible company that is suddenly thinking, that could be really good. But if it falls in the wrong hand, it could be really bad. We need to do something about it. I don't think there is a framework. Everybody is keen to have a framework within which to operate. I don't think there is a governance framework that is there to actually mind those things. We need to work on that.
Do you think financial institutions are prepared for
Well, I think they've been called to meetings in various corners of the world, and I know that we at the ECB will be talking to financial institutions to alert them to those risks. Yes.
Madame Lagarde, we also had elections in Hungary over the weekend. What does Orban's defeat mean for Europe and the world?
I think I'm looking at Peter Magyar victory, which was significant, landslide result. He has 2/3 majority. He can change. This new prime minister can change the constitution, remove, a number of obstacles to both growth and integrity in the governance of that country. And I think that is really to be welcomed. The second thing that it tells me is that Hungary is in the European family, and what I heard recently is that this new Prime Minister, Peter Magyar, is indicating that he would like to see Hungary join the euro area and the forint of Hungary be replaced by the euro, which I think is the natural path of all 26 actually, it excludes Denmark, but 26 member states are expected to be part of the family. And we have 21. If Hungary goes through the process of integration, the convergence and all of that, it would be a great achievement, and it would coincide with what was expected by the founders.
Do you think that the talks on adoption of the euro by Hungary will happen in your mandate?
Wow. You'd have to extend my mandate a little bit, which I think is not in the cards. I'm happy to stay, but no, because, convergence requires a number of reforms, some of which I think Hungary is going to consider and hopefully implement. The judicial one is a point in case. And then it requires an adjustment period, which is usually, anywhere between 2 and a few more years, depending on which country you look at in terms of other practices. But the convergence process takes a bit of time. You need to align a lot of parameters. You need to have the same legal basis on many aspects. But I'm delighted that he's looking at it with a very positive approach, and he's picking up on that basis, which has not been the case for a long time.
Talking about your mandate, will you see it out? Will you fully finish your mandate?
Look, when there is big clouds on the horizon, the captain does not leave the ship. And this captain is not going to leave the ship because I see clouds.
Biggest cloud?
Well, you know them.
What do you see?
We're all facing the same situation with asymmetry, as I indicated. But when you see, major disruption, the energy supply being reduced, when you see threats to growth, upside risk to inflation, these are serious matters that we have to be attentive to and to keep under control, so that our price stability, our 2% target, is not going to be varied from.
Madame Lagarde, Captain Lagarde, thank you so much for joining us. Thank you.
All right, a master class in interviewing our own Francine Lacroix there, sitting down with ECB President Christine Lagarde during the IMF spring meetings in Washington. I thought it was a fantastic way to wrap it up. Because there's been a lot of speculation that Christine Lagarde might leave before the end of her mandate. In fact, a couple of months ago, it was almost taken as a given.
Right.
And now she says, you know what, when there are clouds on the horizon, a captain does not abandon her ship. Also, they covered so much ground, from the war in Iran to the monetary policy issue at the heart of her job to Hungary joining the euro. So really interesting stuff.
And again, just on that point about her not leaving, it does seem like the war in Iran has changed something. And it's also changed something for the ECB. Christine Lagarde early on in that conversation with Francine saying that what they're looking at right now is somewhere between the baseline and the bear case. She called it the adverse scenario for the ECB. That's actually caused this market to start to reprice what they see and what they've been expecting as hikes from the ECB. We're looking at short-term German bonds rallying, or rather the yields moving up nearly 10 basis points. So starting to price out some of the hikes, because Madame Lagarde went into this detail basically saying, yes, people talk about the war being short-lived, but I think about the fisherman who struggles to fill up his boat with gasoline, or the person driving to work that is struggling to fill up a tank of gas. So she's talking more about the growth risk than just the inflationary
Right,
risks.
and pointing out that, her job as a policymaker is a little bit different than, for example, Treasury Secretary Scott Bessent's job as a political supporter of President Trump. She also said that the ECB doesn't have a tightening bias, and as she said that, we started to see real moves in rates. Iran is said to be considering a short-term pause, speaking of, to shipments through the Strait of Hormuz itself to avoid on the one hand, you have to imagine those ships getting blown up by the U.S. Navy, and on the other hand, derailing new peace talks. Vice President Vance spoke yesterday on Fox.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court. We've made clear where we're willing, again, to be accommodating, and we've made clear where we absolutely need to see the nuclear material come out of the country of Iran.
Joining us now is Tyler Kendall, Bloomberg Washington correspondent. It's what a market has continued to be rallying on. Tyler, what do the prospects of continued talks look like between the United States and Iran?
Well, hey, Dani, at this point, it does appear that diplomatic efforts are a viable path ahead as we get this new reporting. To put a finer point on it, people familiar with the matter telling Bloomberg News that this potential short-term halt would extend to any maritime activity by Iran that could violate that U.S. blockade. The reporting indicates that the potential pause does reflect this desire to avoid any sort of short-term escalation at what is considered to be a very sensitive moment in the talks, though the sourcing does caution that things at this point are highly, highly fluid. Now, we had reported earlier that it appears both sides are trying to get a face-to-face meeting done ahead of next Tuesday's ceasefire deadline. President Trump indicated as much yesterday, right, saying that Iran had reached out to the U.S., but also maintaining that the timetable for a deal has not changed. Now, Reuters had reported earlier today that potential talks could take place again in Pakistan, but we are starting to see some mounting speculation that talks could take place in Geneva after Switzerland came out and said that they were ready to assist in the diplomatic efforts. Matt and Dani, as you both know, this White House maintains that the reason why we did not see forward progress after this last weekend's talks is that it all comes down to the nuclear issue and Iran's ambitions for a nuclear program. But there was new reporting yesterday that indicates that the U.S. has perhaps shifted its demands when it comes to this, including reporting that the U.S. asked Iran for a 20-year moratorium on uranium enrichment. That would be much different than previous demands for a permanent ban to that nuclear program.
Tyler, thank you very much for your coverage. That's Bloomberg's Tyler Kendall in Washington, D.C. In the meantime, a market that continues to rally, and for equities trading back above the level they were on February 27th, we are now 0.66% away from all-time highs. We're being led by tech this morning. That's up nearly 1%. NYMEX crude and Brent crude both dropped. For Brent, it's down 3.5% for that for the up contract from NYMEX, down 5.7%. So again, markets in rally mode. Equities look good, despite the fact we are still above $90 a barrel for Brent crude.
Yeah, 90 looks a whole lot better than 117, right? So I think that's what traders are happy about. They could also be feeling a little bit better about some bank earnings. Let's take a look at some of the banks that have reported today. JP Morgan reporting record trading revenue. I believe it was over $11 billion in the quarter, but lowering its full year net interest income guidance, which seems paltry, right? They were going to make $104.5 billion and now only $103 billion in net interest income.
Yeah, I mean, it's some real nitpicking going on. On the flip side of things, pretty happy about Citigroup, that is, investors are. I mean, only up 0.5%. For the first time ever, it had more than $2 billion in equity trading. Another success for CEO Jane Fraser's turnaround plan.
And then Wells Fargo extending declines, delivering disappointing net interest income and reporting $36 billion in exposure to private credit. That's a number that investors were wondering about, and the shares selling off 7%.
And later today, we're going to have the CFO of Wells Fargo on the close, 3 p.m. New York time. But first, coming up, Rolls-Royce unveils a new invite-only car for 100 clients. The CEO, Chris Brownridg, joins us next.
Rolls-Royce unveiling Project Nightgale, its first coach build collection model, at least in the past few decades, an ultra-limited car offered to just 100 clients worldwide. Bloomberg's Hannah Elliott from Bloomberg Pursuits writes, Rolls-Royce is selling something much more ephemeral, true exclusivity, as the company pushes into hyper-luxury and customization. Joining us now is the CEO, Chris Brownridg. So, Chris, this is pretty exciting. I got a sneak preview, I will say, of what it looks like just on someone's laptop. But it is a massive vehicle, and it has a massive price tag to match.
Of course, Project Nightgale is the first of our commission collection motor cars. And what that means is it's a motor car where our clients have had an extraordinary behind-the-scenes experience, but also the motor car they get is extravagant, extraordinary, and will be extremely rare. So it's a very, very special project for Rolls-Royce motor cars.
Matt, in the latter part of that, mentioned the price tag. What is the value of one of these things?
Well, we never talk about money. It's rude. But just to give you an indication, if you were looking at it sits somewhere between our one-of-one coach-built motor cars and our very complex private commissions.
I mean, I got to say, that, probably fair to say this is the most expensive EV ever, right? At least, is that the ballpark we're talking about?
I wouldn't want to comment any further on that right now.
We're talking about $3 to $5 million, probably, I would guess, closer to the higher end of that range. Hannah Elliott wrote a fantastic piece on it. And she shows in her story the Rolls-Royce 17EX, which inspired the shape of the new car. So cool. Who's buying these things? Can you give us any names?
Well, the wonderful thing is that the client base for this motor car were involved in the project 2 years ago. So they've been on the inner circle. And the great news is this is the first time that Rolls-Royce motor cars will deliver a coach-built motor car into the United States. In fact, about a third of the allocation of motor cars that we'll build will come to this country.
Is this, I mean, are you moving away from being a car maker and turning into, a luxury experience provider or a marketer of exclusivity? I mean, it seems like it's customization built on a fixed chassis.
Well, Rolls-Royce is perfectly placed today to really take advantage of the shifting trend in luxury, where it's all about the experience as well as what is actually created. And so every Rolls-Royce that we build today is for a client because they've requested it. And Coach Build allows us to show our potential clients the possibilities of their Rolls-Royce. So Coach Build Collection is a very important project for us, and it's a permanent part of our product offer now.
What does the geographical spread of clients for this car look like?
It is literally all over the world, and that's the wonderful thing. So these are motor cars that will be seen. We have clients in Asia, we have clients in Europe, we have clients in America. So, of course, Project Nightgale will be seen, and they will be driven. Many of the clients who I know are looking forward to taking delivery of their motor car have told me that they will use it every day.
What are you learning at Rolls-Royce that you can pass on to Oliver Tipsa and your parent company, BMW? I was down in your private office, for example, and I saw the level of customization that's possible. The sort of understated luxury of the place, the elegance of it really blew me away. But it strikes me that you're not just a halo brand for BMW, but you also are kind of a luxury laboratory for them.
Rolls-Royce is a true house of luxury. Everything we produce is because the clients asked us to produce it. But what we've seen in the last few years is a clear growth in demand for more complex commissions. Since we've opened the private office here in New York, the level of demand for those commissions has increased dramatically. And we're seeing that at all parts of the world.
How does Middle Eastern deliveries look? We know Ferrari pulled back amidst a war. How are you catering to clients in that region that are dealing with a war on their doorstep?
Well, of course, the Middle East situation is one that we're watching very, very closely. It's an important region for us, and our thoughts are very much with the people that are affected by the situation right now. However, demand for Rolls-Royce globally is still very, very strong. So, of course, it's too early to say what sort of impact that may have. I don't think anyone knows at this stage.
But you're able to sell 100 $5 million cars, let's just say, I'll pick a number, So Ferrari can do this as well now. You see Pagani and Koenigsegg doing this. I mean, is this an unprecedented time where the amount of people that are so wealthy to buy this many products at that level exist?
It's clear that the ultra high net worth audience is continuing to grow, but their tastes for luxury are very much shifting away from just having objects to having experiences or creating objects which are meaningful or personally resonant. And that really plays to Rolls-Royce's strengths. Everything we create is because a client has asked us to do it. And Project Nightgale is a great example of that, where not just the motor car itself, but the client journey is something which is truly remarkable. Remember, these clients have been in the inner circle for 2 years, and they'll be part of the testing process for the motor car as well. So their experience is something that quite literally money can't buy. This is about a relationship that we have with our clients.
One of the experiences I would love to have, and will hopefully someday soon, is a tour of your factory at Goodwood. This is the estate of the Duke of Richmond, where the Festival of Speed happens, and where you have your factory, which normally puts out your production cars. But now you've invested some massive sum, I think 300 million pounds to enable this luxury process. What was involved in that?
Well, it's very clear that demand for more complex commissions is increasing, and it's increasing rapidly. That's a core part of the Rolls-Royce luxury model. And so we've extended the facility in Goodwood so that we've got space for those commissions. It also increases our capacity for more complex paint finishes on motor cars, and also these coach build projects too. The whole principle of Rolls-Royce is about scarcity, so we extend our factory so that we can create more value for each motor car rather than creating more volume of motor cars.
So by the way, do you share your margins? What are your margins and how have they grown?
We don't talk about specific details, but what I can tell you is we make a very meaningful contribution to our shareholder BMW Group.
All right, it's been great having you here, Chris Brownridg. I hope the next time I see you is at Goodwood.
I hope so too.
I would like to go. I don't know when I want to go to the Revival. So they have the Revival there, Dani.
You're gonna have to explain to me
The
what that
Festival
is.
of Speed is exactly what it sounds like, with
festival of
modern
speed,
cars
sure.
and everything. But the Revival is like a throwback. So you dress.
Everyone does.
As if you were in like the pre-war era.
Wait, sorry, what does that mean? You dress as if you were in the pre-war era. What are you wearing?
It's like you go dressed as Downton Abbey, basically, or whatever you like,
it's
right?
It's 1950s clothing. It's a very special event. I'd say it's one of the best events on the calendar.
And there are a lot of pilots. You know, you bring your P-51 Mustang, or you show up in your Rolls-Royce Nightingale.
What if you're from New York City and you don't own a car? What do you show up in?
Am
I still allowed?
You're still very welcome.
Okay, thank you.
Chris Brownridg, CEO of Rolls-Royce. By the way, be sure to listen to my podcast, Hot Pursuit. I do it with Hannah Elliott. She has been to both the Festival of Speed and the Goodwood Revival. Let's get a check on what's going on in the markets as we go to break.
We're only 0.6% away from all-time highs here, up 0.7% for the S&P. NASDAQ goes up more than 1% as yields come in down nearly 2 basis points, and the price of Brent crude with optimism that Iran and the United States will resume their talks and hopefully get something done before the ceasefire expires. Coming up, more earnings. Johnson & Johnson beats and raises on drug strength. CFO Joe Wolk will be joining us next. You're watching Bloomberg Open Interest alongside Katie Greifeld.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks right now, just about an hour into the session. S&P 500 gaining 0.2% at 69.32. Our all-time closing high is 69.68. So if we get to that level or above by the time Katie and Romain come on or at the end of their first hour, it'll be another record. NASDAQ 100 gaining 1% and the Russell 2000 even more right now. You do see crude continue to drop. That's a big help to these indexes at 3.6%. And you got the airlines up on talk of a mega merger. The bank's a little bit mixed after earnings, as you can see. And Johnson & Johnson, those shares right now down about 0.2%, even though the company beat on sales, beat on earnings, and lifted its forecast. With that, I'm going to hand it over to Dani, because she's got a couple special guests.
A real treat this morning, may I say, Matt, because we're going to take a closer look at Johnson & Johnson. And joining me around the desk to do that, first off, is Bloomberg's very own Katie Greifeld, our pharma expert and the CFO of Johnson & Johnson. Joe, Wolk, thank you both very much for joining.
Thrilled to be here. Joe, it's great to see you. As Matt said, it was a beat and raise quarter for J&J, and in particular, there's a lot of excitement around Icotide. That is your new psoriasis pill, just launched. I saw on the call that you said that already about 1,500 patients are on the pill. I'd like to talk about sort of the ambition here.
Sure.
From 1,500, where do you think we could reasonably get to in the next few quarters, and how big do you think this will be for J&J?
Yeah, so Katie, Dani, it's great to be here with you, especially on a solid quarter for Johnson & Johnson to start the year. We think Icotide is one of those key brands that is newly launched, but supports our current portfolio, which delivered today's results and will lead us to double-digit growth by the end of the decade. That's saying something on a $100 billion business. With Icotide specifically, Jennifer did share some of the results early on. And just to keep this in mind, this drug was approved only about 10 days ago. There's already 1,500 patients that are on the drug, about 1,000 unique prescribers. So the receptivity and the demand is already showing to be there. In terms of an overall number, I couldn't give you that today. We do think it'll be one of Johnson & Johnson's largest drugs ever. It provides a great opportunity, an option for prescribers and patients to have an oral option with biological efficacy, biological safety. Right now, if you have psoriasis or inflammatory bowel disease, you have to use an injectable, a biologic, for most effective relief. This will provide, we know that about 60 to 70% of patients will avoid a biologic, whether it's the stigma of my disease isn't that serious and wanting to fess up to that, or just an aversion to needles. We think this really comes in the treatment paradigm almost first line right after some creams and solutions that are usually ineffective.
So this is a real winner for you.
We believe so.
When you look at the portfolio as a whole, you and the industry is dealing with this big patent cliff. And I wonder if there are any more holes that you want to fill as you get closer to those dates of expiry.
Yeah. You know, that's what I love about our portfolio. Our patent cliff is in the rearview mirror. So we encountered Stelara loss of exclusivity here in the U.S. first quarter of 2025. It was an $11 billion drug. We're one of the only companies to ever actually grow through a patent cliff of that size. We lost about 45% of that business last year. And the portfolio continues to grow. These products that we have in-house will have some patent cliffs, but they're not anywhere near the size. And that's what really, I think, gives me comfort in my role as CFO is we don't have to do deals out of desperations to make up for patent cliffs. We started thinking about the loss of Stelara the middle of last decade and made sure we had the pipeline and the product portfolio to compensate
just to that point, you did last year's biggest biopharma deal. Does that mean deals of those size are also in the rearview window for you?
No, I think we're going to be much more strategic. So people often ask, hey, what do you think about the M&A market? Is it hot? Is it cold? To Johnson & Johnson, it really doesn't matter. Is there a strategic fit? And by that, I mean, is there a scientific expertise or an insight that we have? Is there a commercial capability that we can maybe provide better access for patients? And that's 80% of the discussion with our board. The other 20% is making sure we compensate shareholders for the risk that we're bearing on their behalf. And we'll have different return quarters, if you will, based on where that asset is in its life cycle. If it's a marketed product, maybe in the med tech space, you can get closer to the cost of capital because it's really just commercial risk. If it's a phase 1, phase 2 asset, you're going to look for a higher return.
Just to put a bow tie on the discussion on deals, to Dani's point, I mean, you're known for being acquisitive over at Johnson & Johnson. And you think about the divestiture you have coming up, orthopedics going to be spun off from devices over the next year. After that point, once we get through that transaction, I mean, should we be on the lookout for deals from J&J?
Yeah, we're always acquisitive. I mean, if you, as you said, I think over the last 3.5 years, we've deployed about $60 billion in capital. About $45 billion went to 3 deals. We had another 25 deals that ate up the other $15 billion. So we like those smaller deals. That's really part of an integral part of our playbook. But when a strategic asset makes sense, and in last year's case, it was Intracellular and the addition of Caplyta, which fits nicely into our historical legacy and success of neuroscience.
So J&J not afraid of deals, also not afraid of spin-offs. As I mentioned, you know, spinning off orthopedics from devices. Do you anticipate further spin-offs when it comes to the devices unit specifically?
Yeah, well, part of our responsibility as an executive team and as a board is really to ensure that we're managing our portfolio with rigor. How we view that is if we don't have a right to be number 1 or number 2 in a marketplace with significant innovation on the horizon, then we probably could do better with our efforts, better with our resources, and we can create value elsewhere. I love the portfolio where it's at right now. If you think how clean it is with respect to on pharmaceuticals, oncology, immunology, neuroscience, in medtech, it's surgery, it's vision, and it's cardiovascular. We're now the leading growing company in terms of cardiovascular, where we weren't much of a player other than our electrophysiology space, which was clearly a winner 3 years ago.
I do want to talk a little bit about expenses as well, especially when it comes to marketing, because you said that you're setting up a separate sales force for Icotide, which again was only approved about 10 days ago. You think about some of your efforts when it comes to Tremfya's strength as well. A lot of that points back to marketing spend. I know you said in an interview with some of our colleagues over at Bloomberg News that you plan to front load a lot of these expenses. Just talk us through how you expect it to develop as the year progresses here.
Yeah, this is another part I like to our story. So we came out, we actually set expectations a little bit higher than the street was expecting in January. And here we are today raising already. It's not common that this early in the year we tend to raise guidance. Maybe it's a 50-50 bet. We did raise guidance today because we feel really good about our business. The investment is front-end loaded to go with the timing of the launches of these new products, with some of the R&D clinical trials that will develop over time. We expect improving margins as we go throughout the year. And we've reaffirmed our commitment to at least 50 basis points improvement throughout 2026. As sales trajectory goes higher, we think that margin profile improves in the outer years. We'll be having an investor day in December to take analysts through a bunch of these details, how we plan to get to double-digit growth, how the profit will come along for the ride, so to speak, in that case. And we think we're very, very well positioned. We also did have the opportunity to increase our dividend today for the 64th consecutive year.
Joe, one of the big stresses for this industry has been any additional tariffs. And I know you, the team, have been confident that given your deal that you have with the administration, that you won't be subject to the Section 232 pharma tariffs. Has that been confirmed yet?
Yeah, that's right, Dani. Based on all the discussions, which are very productive with the administration, it appears that our MFN deal structure in place would avoid those 232 tariffs. Right now, we've got about $500 million built into this year's projections. We'll see how it plays out in the courts with whether the authority was there. It has to be replaced with a 10% tariff, so there maybe is some upside in our P&L as we look forward throughout the balance of this year, should some of those tariff decisions be reversed.
Joe, thank you so much for joining us. Appreciate your time, Joe Wolk, Johnson & Johnson CFO, and a huge thank you as well to Bloomberg's Katie Greifeld. And Matt now is standing by with our next guest. Matt Miller, take it away.
Yeah, I want to stick with healthcare because HSAs have been front and center, healthcare savings accounts. With tax day coming up tomorrow, more people are focused on it. Health tech startup TrueMed helps consumers use tax-advantaged savings accounts to buy a range of wellness products, including exercise equipment, saunas, and supplements. Joining us now is Justin Mares. He's the company's founder and CEO. Justin, great to have you here with us. I have to ask first, ahead of April 15th, right? Are many more people signing up? Are many more people paying attention to this as we get to tax day?
Oh, yeah, certainly. I mean, HSAs and FSAs on their own are growing 10 to 12% a year for the last couple of years. There's around $159 billion in HSAs and FSAs today. And what we are seeing is increasingly millennials and Gen Z people, they're interested in opening and contributing to these accounts at rates that we've just never seen before. We recently ran a survey that found that 89% of Gen Z and millennials that had access, had the ability to open an HSA, we're opening one and we're contributing to that account, which is a pretty novel thing in terms of this financial behavior.
It's definitely big, and I know a number of younger people are using platforms like yours. What kind of competition is out there? I've heard of other products like Dr. B, if somebody needs physical therapy or wants to get a gym membership paid for by an HSA, they'll go to TrueMed or other platforms to do that.
Yeah, so the biggest competition, frankly, is apathy. Like for most of the time that HSAs and FSAs have been a thing, the average American has not been able to talk to their doctor and have their doctor prescribe a sleep intervention, an exercise intervention, something like that. And so what we're really advocating for and what we've built is a tool that makes it easy for qualified individuals that are trying to treat, reverse, or prevent a condition to spend their HSA or FSA funds on things like, exercise intervention, gym membership, as you mentioned, sleep aid, supplements that thousands and thousands of studies have shown can actually treat or reverse many of the chronic conditions that so many Americans are sick with.
And it makes a lot of sense. Obviously, prevention is key. It's much better that I go to the gym and work out, and my heart's in better shape than I have a heart attack later and end up at the hospital. How do you prevent, though, the scammier supplemental sales, right? These vitamins or powders and pills that people tend to waste money on?
Yeah, so we have kind of two steps to our process. One, we have a medical advisory board and a clinical team that will review sort of the body of evidence and look at thousands of studies that have been published in multiple journals, peer-reviewed journals, and say, is there a reasonable argument and case study for things like omega-3 supplementation or creatine or magnesium for sleep, like these sorts of things that the literature is frankly very clear on as effective interventions. That's part one. Like, is the compound actually effective? Part two is we look at the actual merchants and look at the supplements they're selling, and we say, is the dose effective? Is it well sourced? Has it passed certain cleanliness and other sort of certifications that we look for? And frankly, we turn away about 40% of merchants that come to us wanting to work with us because they don't meet our quality bar or efficacy bar.
What has your interaction been with the IRS? And what has your interaction been like with this administration? Because I know there was previously a co-founder that worked with you who now has gone to work with this administration.
Yeah, so we started the company when, in the Biden administration, HSAs have been a thing for 20 plus years. Like, the explicit purpose of these accounts is so that people can either save money or spend it now to improve their health. So that is why we started the company. We've engaged with stakeholders in the administration and at the IRS just around what we're doing. But the big movement that you're seeing, regardless of political administration today, is there is this movement towards root cause. There's a movement towards lifestyle. There's a movement towards let's actually focus on how we make Americans healthy. And let's focus on a bunch of the things that, frankly, are just poisoning us and making us one of the sickest countries in the world, where we have the worst outcomes with the highest amount of spend of any OECD country.
What about your interaction, or have you received any encouragement from health insurance companies? Because it strikes me that if you do what you're saying, right, you end up also saving money for health insurance companies by preventing diseases that they later have to treat.
100%. Health insurers really like what we're doing because there's not really a mechanism in today's healthcare system where a health insurer feels good or excited about saying, hey, I'm going to cover your gym membership or something like that. Almost little less than 3% of all healthcare spend goes towards anything resembling prevention. And so HSAs and FSAs are this really interesting bucket of funds where it's up to you as a consumer to decide, hey, do I actually think that my gym membership or this sleep aid is going to help drive health results for me? And we're basically making it easier for individuals to make these health decisions for themselves. And many, like hundreds of millions of Americans, in my view, over the next decade are going to decide to invest their own HSA, FSA dollars in things that look like preventative measures.
All right, Justin, really appreciate the time. I have a million other questions, but I know you're going to go on Bloomberg Radio in about an hour. So I'll give my questions to Paul Sweeney and Scarlett Fu. Dani, what's up with the markets? How are they looking right now? We're getting closer to a record?
Pretty good. We're about 0.6 away from a record. We are higher this morning, and tech is leading us there. We're up by more than 1% for the NASDAQ. It is optimism for this market that there will be some sort of deal reached between Iran and the U.S. as talks are likely to continue. That's enough for us to completely price out, at least for equities, any war risk premium. We still, though, are looking at NYMEX crude above $90 a barrel, but significantly below $100 a barrel. So optimism for now. Coming up on tomorrow's show, Morgan Stanley CEO Ted Pick off the back of their earnings, WeWork CEO John Santora, Gerard Cassidy of RBC to wrap up all the bank earnings, and Catherine Bordelme of Goldman Sachs. Again, as markets stay in rally mode, optimism priced in this earnings season. That's it for Bloomberg Open Interest. See you tomorrow, same time, same place.